What is going on, everybody? Rasul Siri back at you guys with another presentation. Today is February 5th, 2025, and I see we already got quite a few people here. A lot of new faces that I don't know because these are usually connections from our investor relations team that we got in our group. So, since I'm not familiar with everybody, let me know in the chat if you guys can type where you guys are calling in from. Because I know it's 10 o'clock here on the East Coast. So if you guys are troopers like me, hanging on by the last bit of energy because I couldn't, I was waiting to like, should I drink coffee at 9:30 at night to try to do this, or do I just tough it through? So I'm gonna tough it through, and I've been up since like 5 a.m. So Norwalk, San Jose, California. Let's see, let me open this chat. All right, Toby's in Florida. The Lawrence is in Norwalk, California. Winnipeg, Manitoba, Canada. Jonathan Lane.
My
Uh,
man Lane.
there you go. Gabrielle in St. Louis. Jasmine Jackson, also in St. Louis. That's what's up. We're going to be talking about a deal in St. Louis, so you guys can go ahead and drive by and touch that deal if you really want to. Just don't stay too long because we will trespass you. Uh, very protective of our tenants, all right? If you're not paying rent there, you don't need to be there. San Jose, a neighbor of our very own Michael Payne. Um, cool, 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 cool. And Tony from Palmdale. All right. And so I know there's probably a varied list of experience that people have with commercial multifamily investments. So, on a scale of 1 to 10, let me know what your familiarity is with these types of investment vehicles so that I know when I should explain more or when I can just, uh, stay a little bit more high level for folks. Let me know what you guys' experiences on a scale of zero. You can say 0 to 10, basically, if you don't know anything. Toby is a pro with a 9. Philip feels like he's between a 5 and a 6. Most people should be some sort of, hopefully have some level of knowledge about how some of these things work. Uh, and if you don't, it's okay. I'm here to answer questions. I educate people quite a bit on my social media. Tony is like, I have no idea, never seen one of these before. Uh, 2 to 3, but he's got Google and he's a math whiz. Awesome. Yeah, and this is all math. That's one of the things that attracted to me. As by trade, I'm a financial analyst, and when I learned about these investment vehicles, like I was doing traditional residential real estate, but when I learned about like the exponential growth that you can get from doing a relatively minor value addition to one of these properties, it was mind blowing. It felt like cheating. I was like, you can do a 10-year residential deal in a single commercial deal, and it's absolutely insane. I've done quite a few. Okay, so a lot of newbies, a couple of people who got some pretty good experience, but for the most part, it sounds like the majority of people are newer to these types of things, and that's cool. That's cool. I like when people learn about this because it's kind of mind blowing. Because traditionally, when we do our investments, we're taught about putting money in the S&P 500 and earning your 8-9% year over year. If you get some dividends, they might be paying out an awesome, very high dividend. Anybody got some dividend stocks that are paying out more than 1%? Right? Okay. DeLawrence says he used to be a realtor, went through the commercial real estate class at Berkshire Hathaway twice. That's how good it is, guys. He went to it twice. Right? So that's pretty cool. That's pretty cool. So I'll let you guys know a little bit about me. I'll introduce myself. My name is Rasul Mutawakil. I am the owner and CEO of Rasul CRE, commercial real estate. I have done about 23 multifamily syndications through syndications and or JVs, joint ventures with other investors where we didn't raise outside capital. We just, between a small group, we've done a few of those deals. And I've done a grand total of about 4,021 units of commercial multifamily. And my strongest suit is underwriting, the analytics, 'cause I'm a financial analyst. When I get into spreadsheets, I nerd out, and I love looking at which deals make mathematical financial sense and which ones I think these guys are kind of reaching like way too far, being overly aggressive. And you're starting to see that. I don't know if you guys have been following the multifamily industry lately, but there are a lot of people who are getting ready to face a lot of pain because they were overzealous in the buying over the past few years, and they got caught up in the rapid increase of interest rates starting in 2022. And that's the whole entire mathematical equation. If I'm going to teach you guys anything about how this business works, it is basically buying a property, improving its operational performance, its net operating income by a certain amount in order for you to be able to make a sale at the end. Essentially, syndications end up being large scale fix and flips. That's really what it is. The joint venture deals that we do, sometimes we do the fix and flips. Sometimes we just want to do a cash out. We pull all of our equity out. So we have no cash in the deal. Sometimes we get paid a little bit for doing that as well. If the value addition has been increased sufficiently. And then we can go ahead and roll that money into another deal while we have this cash flowing asset that's going to appreciate at a later time in the future as rents continue to grow over time, right? So that's the long-term play. In the short term, usually about 3 to 5 years, we're looking to double our investors' capital because we're targeting about 15 to 20% internal rate of return. So if you know the rule of 72s, where you take 72 divided by your interest rate, that's how many years it's going to take for your investment to double. So that's in a nutshell what we do. We buy a property, we inject capital into the units to make them look a lot nicer, and then nicer units will fetch nicer rents, and that increase. As a quick example, as a high level, I'm only doing this because there's a lot of people who wrote zeros in the chat. If you take a 100 unit property and you increase those rents by $50 a month, it's not a lot. A $50 rent increase on 100 units, it's only an extra $5,000 per month. Not going to make anybody rich, right? And then you factor that out over a year, that's an extra $60,000. But at a 6% cap rate, capitalization rate, that $60,000 to a financial institution like a bank will value that property by an additional $1 million. That is how the magic of multifamily works. It's all about the math in there. You increase that bottom line, the valuation. It's very akin to buying businesses. You guys have heard of people who get in, they buy a business, and then they'll increase the performance, and then they'll sell it for a higher multiple on the back end. That's exactly what we're doing. It's commercial real estate, and that's how we do it. On the residential side, you can't do that. A property, like a single family house up to a quad, is only going to sell for whatever your neighbor across the street sold that property for. So you're bound by area comps and everything else like that. And it's true that in the commercial space, we are also bound by what our rents can fetch. But we only need to have that $150 to $200 range in order to hit really successful targets, which is I'm going to tell you guys about this deal that I've got going on right now. So let me go ahead and go through this presentation because I want to be respectful of everybody's time here. And then if you have any questions, save it to the end because typically I probably will go over whatever it is that you're thinking about. And if not, write it in the chat box or just write it down and ask me at the end, and I'll be more than happy to field a couple of questions for you guys. Sounds good? And if things that I'm saying are making sense, put something in the chat box so that I know people are awake and I'm not just muted talking to myself or something like that. So I like fireballs. People throw fireballs in there for me all the time. That'd be really, really good. Appreciate that. Go ahead and share this deal. All right. Thumbs up. I like those too. All right. So the deal that we've been working on for the better part of about 6 to 8 months at this point. It's called the Donatello. This is a 28-unit apartment building in the central west end of St. Louis. My fun fact, my very first passive investment into the commercial multifamily space was in St. Louis. And a friend of mine that I knew, he was, he's like Midas touch. Anything that this guy touched was always super profitable. And I was like, all right, let me get a part of this deal. I invested into the northern part of St. Louis. I didn't know about St. Louis as a market. I'm from Miami originally, and I still live there. And when I invested into the St. Louis market, I didn't know what I was getting into. And the north part of St. Louis was not ideal. It's not where you really want to be. There's a lot of opportunity, but it also comes with a lot of risk because it's a lower income demographic, is higher crime and things of that nature. And so I kind of stayed away from St. Louis for the longest time. And so when my business partner, Mickey, had brought me this Donatello deal, I saw the numbers and I was like, oh, that's fantastic. I said, where's this located? She's like, oh, it's in St. Louis. And I was like, pass. Right away. I was like, no, thank you. I'm done with St. Louis. I'm not keen about it. And she's like, Rasul, have an open mind. Not all of St. Louis is like that. And so I was so compelled by the story that she told me about this property. I jumped on a plane and I went over there and I landed around 10 o'clock at night. And it was night and day from the property that I originally invested in. I wish I would have been in the central west end of St. Louis because it is like one of the most revitalized parts, if not the most revitalized parts of the St. Louis County area. On the same street where this property is, just a couple blocks down, there are single family condos that are going for upwards of $1 million. It's like extremely fancy and really nice. There's a couple of disclaimers that you go through. You guys are all going to get a copy of this if you haven't done it already by visiting the investor portal from the member of our investor relations team that had brought you guys here this evening. So I'm not going to read this slide to you guys. Do it at your own leisure. There's a financial disclaimer as well about our estimations and our pro forma. Cool thing about this, we've actually already closed on this deal and we've been operating it for the last 4 months. So I'll show you guys what the pro forma is, and I'll show you what we're actually doing on this deal. Quick introduction to the team. The principal who's running this deal, boots on the ground, Mickey Jones. She is a crazy rock star in almost everything that she does. She's a financial coach and she is a project manager by trade, and she is used to juggling a lot of projects at the same time. Charlie Peters, my other partner, he has signed on this debt with me. We're both sponsoring this loan for to acquire this property. Charlie's been in commercial real estate, I think, since he was like 25 years old. This picture is actually a younger looking version of him right now. He's full white hair at the moment. And then, of course, myself, Rasul Wakil, I've told you guys about my company, Rasul CRE, and I also have Mara Capital Group is my holding company for all my real estate investments. So track record, these are a few deals that we've done. The two on the right are the ones that Charlie has done. These two on the left are the ones that I have done. Most recently, uh, Oakwood Gardens, we had bought in Cleveland Heights in Ohio. And that one we only held for 13 months and got 34% returns for our investors on that one. Sunset Townhomes got caught up in the whole interest rate crazy roller coaster of a ride, but we weathered through it. And on the back end, we sold that last year for an average about 45% year over year returns for our investors. So that was a really like big home run. We had like a crazy issue with a fire, had insurance come and take care of everything over there. So not everything is peaches and cream every single time you do one of these deals, but as long as you have a good manager in place to be able to keep an eye on everything and do what you need to get done, then there's typically no issues. So one of the reasons why we love St. Louis, uh, specifically this deal, if you guys recall, I don't know if you're jumping into this call a little bit later, you might have missed it before when I said one of the difficult things that the multifamily industry is facing right now are the increased interest rates that have been like basically decimating people's property values. Going into this deal, we are assuming the already in place Freddie Mac loan that's at a fixed rate of 4.5% interest for the next 3 years. And then also our debt service on this property going into it, which is basically our cash flow ability. Our cash flow on this deal, we're able to pay this mortgage plus an extra 80%. So you have a DSCR of 1.8, which is a fantastic number. A lender typically looks for about 1.15 or 1.2 in order to feel comfortable with that loan. I kind of look for 1.3 to 1.4, and this one was starting off at 1.8. So it was just fantastic. how it's going to be doing, and a large part due to the fact that we got this unicorn of an interest rate. You can't get a 4.5% interest rate anywhere you go today. Not possible. We're extremely conservative with our approach on how we try to find a property. It's almost like a needle in a haystack type of game. We've gone over 200 properties actually that we had vetted to try to look to see if it fit our buy box. And that's how rare it is to be able to find something that is worthwhile to pull the trigger on. It's just a lot of grunt work in the beginning, but once you do find something, you got to be able to jump on it and take advantage while you can. So this is an overview of the investment. Multifamily deals have they're multifaceted, is why I feel like they're much more superior to 401k and stock investments and everything else like that. Number one, the potential returns. Um, they're super stabilized because at the end of the day, you never know what's going to happen with the business company that you want to invest in, but people will always need a roof over their heads. One of the biggest reasons why I like it as a hedge against market risk. The stability. Has anybody ever been a residential real estate? Have they really owned any single family homes or anything else like that before in the chat? Oh, Jonathan Lane's putting some facts on there with the DSCR. And thanks for saying that, by the way. All right, cool. All right. I know there's a couple of residential investors in there, but I'm going to hide the chat for now because my screen's relatively small. The whenever you have a residential portfolio, which is I started off with residential investing, when that tenant would eventually move out, and they always do, um, I lost 100% of my income on that house. Versus when a tenant moves out of a multifamily property, I still, in this case, will have 27 other tenants, paying on a regular basis. And then the demand in the central west end of St. Louis is so high because everywhere else is so expensive. Um, Being able to provide that middle market area, our demand is we always maintain basically about a really high 100% occupancy level. So it's very stable. You have that income stream because of the cash flow from the renters paying every single month. We have no collection issues whatsoever. No people who are just, I promise I'm going to pay, just give me some time. There's none of that in this market. Very different from the north part of St. Louis. Freeze. Okay. So here's a summary of the property. Let's give you guys some quick details. This property is kind of like the ugly duckling in this brand new area of St. Louis. The properties to the left and to the right of this building were like multi million dollar properties. Like they're selling for over 20 million dollars plus. And the rents at these properties are about 2,300 for a two-bedroom, one bath. And I think smaller square footage, about 700 square feet. In the Dontal, it's a 28 unit multifamily apartment building. It's two buildings, two roofs, and each one has 14 units, and they're all two bedroom, one bath. So it's same as what we're looking at the neighboring properties as well. Got over 21,300 square feet. And there's some green space in the middle. Not so green right now because it's a little chilly with winter. But again, that location, the top three things that you always want to think about whenever you're buying real estate. This area is unmatched as far as the city goes. So it's a little bit of an older property built in 1963. Again, it consists of two buildings. Our average square footage unit size is big. We're 900 square feet in like a central downtown area. And our average rent right now, when we took over the property, was $1,000, 1,057 on average, and has 100% occupancy. One of the telltale signs that your rents are way too low at your property are if when you have 100% occupancy. That means it's so cheap that nobody wants to leave and they want to stay for as long as they possibly can. In providing market value by putting improvements and renovations into these deals, we entice people who are willing to pay a little bit more. And I'll tell you some fun facts about that when we go over the actual performance of our pro forma. So here's some more highlights. You guys can read a little bit more. Central West End. It's like the central cultural hub of St. Louis. There's a lot of art museums. They have the Contemporary Art Museum, And then it's really close to a lot of medical facilities as well as SLU, St. Louis University. Very big prestigious school over there. There's a lot of international students that come in from all over the world to study at this school. And the neighborhood is just it's very attractive for the right demographic that we've been pretty much targeting the people that we want to have as renters in there. So we'll have a pretty strategic value add. Uh, we want to be able to upgrade a couple of the classic units and bring them to what the standard is in that area. Backsplash in the kitchen, undermount sinks, all these things you see here, the stainless steel appliances, and we're gonna do a little bit of work on the exterior to be able to give it more of a modern look. Because again, it's an older property. We want to be able to stand out as a nice little boutique area that may not be as brand new as these Class A properties to the left and to the right of us, but it's still something that belongs in this area that people are going to be like clamoring to get into. So this is some pictures of what it looks like inside. You can see that the previous owner had already put track lighting inside all the units. They got rid of what we call them the boob lights. You know, it's the those domes, upside down domes that they have, the lamps. Most of the units have in-unit laundry with the washer and the dryer, and it's been converted to central air and heating as well. They used to be all window units. We still have a couple classic units that are window units, and they're actually renting pretty well as they are right now. So we may or may not actually put the money into it to convert it to central heating and central air. And the reason behind that, by the way, is because once we do plan on exiting, one of the biggest things or mistakes, I should say, that some newer investors try to do that they make is they over improve the property by not leaving any room for the next guy to increase the value of the property. So you got to leave some opportunity on the table strategically so that you can make sure that the person who's going to buy it has a way that they can reach their exit. And by the time they go and do their value add, whatever we would have done would have been about 5, 6, 7 years old. So maybe even 10 years old at that point, and it would be due for a refresh. And that's the cycle of commercial real estate. So the unit breakdown, very straightforward. All two bedroom, one baths, 28 units, 900 square feet. Average rents are 1,057. We're targeting $1,350, right? So that's an increase of 300 bucks per unit in this property. Now, the CoStar reports that we were looking at were showing that the average rents for this vintage property in the Central West End were 1460. So to the left and the right of us, there are like $1,300 more than what we're charging a takeover. And what the average is going for is 1460. Our pro forma, our estimations for our projections, we're only shooting for 1350 in order to hit our target ideal numbers to be able to hit that 15, I think we're about 17% internal rate of return. And I'll show you the pro forma in a little bit. So here are the details. We're looking at about an internal rate of return. Essentially, that's just how much a return on your cash investment at the end of our deal. Once we do the disposition and the sale of the property, we're estimating about a 17.49, assuming we can get that 1350 and that we would have spent about $10,000 in upgrades for each one of those units to be able to get that. Our cash on cash return is about 10.44. Again, a lot of that's due to the fact that we're super low leveraged. We're not over borrowing on this property, where I think our loan value is about 65%. So we have 35% equity going into the deal right off the bat. And there's a 7% preferred return. So let me take a minute right now to explain to you guys how 7% preferred returns work. Preferred returns are the monies that you get paid as an investor into the deal ahead of everything else that happens. So the way the typical cash flow in the deal will work is we collect all of the rents, we do the expenses to pay all of our bills, and then whatever's left over is our net operating income. That net operating income is then going to be used to pay down our debt to the lender because they're the first lien holder. And then whatever's remaining after that is our distributable cash. Now, that distributable cash is not going to be split up between the general partners and the limited partners or the investors. It's going to first go in a preferred status to the investors. So until they make 7% on their money, And then once they get paid their 7%, then we go through the waterfall of the deal where we have a 70-30 split. So 70% after you get paid your 7%, 70% of the proceeds after go to the investors. And then 30% goes to the managers of the deal. So that is the incentive for investors to be involved in these deals because, again, on a very high cash flow deal like this, the first 7% goes to you guys. We have a 50K minimum investment for this deal, and it is a 506B syndication, which I'll talk about that in a little further on. So this is our plan right now, and this is how we're actually executing on this. Number one, we're self-managing. Again, it's a small enough property, and again, Mickey actually works 10 minutes away from where this property is located. That's how nice this area is, and it's convenient for her to be able to get there and do whatever needs to get done. And she's been doing a phenomenal job of engaging with the tenant base and all of our clients and our customers there, and also executing on the business plan renovating the units. Now, here's the interesting thing. If you remember, I said our business plan was to inject about $10,000 per unit in order to achieve that $300 return. So we're going to spend 10K and increase the rents by $300 for each one of these units so that we can increase that NOI, get that higher valuation, and sell. We had one person move out and uh, immediately that unit rented for $1,400 and we didn't have to spend more than $1,500 just to do the paint because these units are already renovated. This guy was just keeping the seller, he was just keeping all the rents really low so his occupancy would stay high because he owns about 1,000 units in St. Louis. So he's a really big investor there. He actually texted me the other day. He wants to sell me another one of his properties which I'm going to be looking at. So if you don't make it onto this one, there may be room on that one coming up in a little bit. But as of right now, we did not have to put nearly as much capital, and we're getting not as high of a return, but we're getting way more without spending nearly as much. So the balance there is highly in our favor, and it's not going to be projected on our pro forma. But it's going to be a massive increase to our NOI without having to spend nearly that much money. So that might be a savings if we can keep that trend. That's only one, and we want to be able to see probably about at least three to confirm that this is what the market is calling for right now. Once we get three of those, then we'd be solid. And I'd feel comfortable in saying, okay, this is what we're going to do from going forward. So this is you might want to take a screenshot of this, or I mean, you're going to get a copy of this anyways. But this is our transparent fee structure. The 7% preferred returns. The Class A investors then get their 70%. The Class B, which are the general partners, get their 30%. We have no property management fee, again, because we're self-managing. Typically, that's anywhere between 7 to 10% of the bottom line that we are keeping for us, right? It's more distributions for our investors. We do have a nominal asset management fee, basically to pay Nikki and the rest of the boots on the ground team for doing the work that we do. There's an acquisition fee for being able to structure this deal, put everything together. We have to come out of pocket to put everything together. This basically helps reimburse us for our expenses in getting the deal done. And then there's a capital transaction fee once we go through either a refinance at the end to be able to put another set of debt once this one expires, because we're going to ride this out for as long as we can. If we get the full 3 years out of it, that's going to be fantastic because we're going to be paying down our loan balance along the way as well. So we would have higher proceeds when we leave. So the fund sources, we got 2.27, basically 2.3 million bucks in a loan. We're raising $1.6 million of equity from our investors. So our total sources and uses is $3.88 million. The purchase price, it was originally 3.3 million bucks. And at the end, when the seller retraded us, and he got us to 3.4 because we were officially under contract at 3.5 and we tried to negotiate to 3.3, which is where we had it when we made the pitch deck and put it in our PPM, but we ended up buying it for $3.4 million. So our closing costs and our fees ended up being about 224,000, and our estimated repairs and reserves basically to do all those renovations which again, that's 280,000 of that was supposed to be for interior renovations, and the rest of it was for the exterior and new roofs on both buildings. That would have come to 364. That's going to be a massive savings right there. If we can even cut that even in half, we'd have a lot less cash that we need to be able to do that, which just means that it's a bigger ownership for your $50,000 investment at that point. So total uses there, $3.88 million. So based on $100,000 investment, this is kind of like the way the cash flow would work, right? So in the first year, if you have $100,000 in the deal, the cash flow from our estimations is about 6,350. So you're making 6.35% of your money in the year two. Same thing. We're amortizing a little bit better. The rents have increased over that year as the leases have expired. So we're making even more cash flow to be able to distribute. So you're making about 7.77%. And then at the end of year three, when this loan that's in place expires and we refinance, we'll be doing about 8,509, which is an 8.51% cash on cash return. And then we're going to be redistributing about 60% of your initial investment back to you, right? So that's a return of your capital. Once we refi, your exposure now is only about 38% of what you initially put in there, but you're still getting your cash flow from your ownership percentage. Even though you give up or you get back 60% of your initial investment, your ownership percentage does not get diluted as a result. You keep the same amount of ownership that you had going into the deal. So now you still get 5,420, which is going to constitute a 14.11% cash on cash return on that $38,000 you have remaining in the deal. And then we're going to ride that out until that next loan expires. And then we ultimately sell. We possibly could refi, but we always just project for a sale. By that time, you're looking to get back an additional $42,000 plus the return of your 38. And that comes out to about $83,000 in total net profit to you, very conservatively, assuming that we had to spend the 10,000 per unit and assuming we can only get $350 in rents. So we're underestimating how much rent we can collect and we're overestimating how much money it's going to cost. And I do that strategically to make sure that if I can, worst case scenario, everything goes bad, we can hit these metrics. But when things go better than planned, like we get a $400 rent bump that only costs us $1,500. That's how you will get returns like what we saw on my initial properties at the Oakwood Townhomes or Sunset Townhomes and Oakwood Gardens, where we're getting 34% returns or 45% returns year over year. That's how that happens. I only project to hit bare minimum 15%, ideally somewhere around in that range, 15 to 20. We're right on the mark here, 17.5%, with our initial estimations. Hopefully that makes sense for you guys. If you guys have questions, I can't see the chat right now, but I'm going to address them in a little bit. So, management services, what do we do, right? Our general partnership team, what are the things that we do? Number one, the due diligence. We went through and inspected every facet of these buildings and all of these units. We walked into every single one, took notes on what we needed to get done. That's why we know there's only two units that need the conversion to central air, which we probably won't be end up doing just to be another cost saving measure. It's less cash that we need to use and deploy, and we're still getting really high returns on the rents just because the market's going crazy in the central west end of St. Louis. The management updates, we do live calls. The next one's going to be March, in the beginning of March for all of our current investors, and hopefully some new investors who come on with us to do this. You guys will be able to get these updates. You can see pictures of the property. We do regular site visits. Again, Mickey, Harvey, they're both boots on the ground. Even Gabrielle is also in the area as well. She's one of our investors who's local to the deal, and she comes by and visits and takes a look. And then we have the management oversight of all the financials. We have our fee accountant that handles all the day-to-day. So she's third party, make sure that all the numbers are kosher. We put those in our reports that we send to you guys on a regular basis. The distributions are slated to start in April. We give ourselves that first 6 months to test everything out, make sure that the property is going in the way that it needs to go, so that we can, number one, make sure that we can collect the rents that we're supposed to collect. Um, uh, I still had that little gripe about North St. Louis, so I was like, let's see what these collections look like. And 3 months in a row, we've had 100% collections, zero delinquencies. Nobody was ever late on anything. So I couldn't ask for a better tenant base. Another fun fact, for people who are not moving out that are still tenants there, we're giving them the option to say, hey, we can give you one of the refreshed units and you can pay the 1350, or you can renew and stay where you're at for 1200. And a lot of people are opting to just stay in place, not move, and pay $200 more without us putting any money into that deal, into that unit. So that's the current happenstance of the property right now as it's going. So the investment criteria, again, this is a 506B. It's open to both accredited and up to 35 non-accredited investors. That's what a 506B syndication offering is. You don't have to have a net worth of $1 million or more. You don't have to have an income requirement of $200,000 per year for the last 2 years, or 300,000 if you're married. Those are for 506C offerings, which are only for accredited investors. So if you've been brought here and you're not an accredited investor, congratulations, because the person that's linking you to this deal is the only way that a sophisticated non-accredited investor can participate in these type of private equity deals. We accept cash, self-directed IRAs, solo 401ks, enhanced qualified retirement plans, certain 1031s. That's no longer a possibility because we already closed on this deal. That's actually one of the coolest things about this presentation is the risk of this deal not closing or not making it to the finish line doesn't exist. We own and operate this property already. We are already hitting beyond our pro forma numbers, and it's costing like a fraction, like maybe 20% of what we initially thought it was going to cost us. Absolutely like mind-boggling how well this deal is working out right now. And again, the minimum investment is 50,000. And the investors in this deal, again, because we've already raised about $500,000 to get this done. And you might be asking, why are we doing a presentation if we've already closed this deal and what we're doing? In order to get this deal closed on time, what we did was we took out a business line of credit and we took out a hard money loan. And both of those things combined provided enough liquidity at the time to be able to get the deal done. Now, the issue with that is that both of those loans are very cash hungry up front. And so they're cheaper in the long run, but they take too much cash flow out of the deal in the beginning, and we need to replace it with investor capital so that we can pay the investors on the back end out of the cash flow through the waterfall model. That's typically how these things go. If we were all flush with cash and we could service the debt on both these things, on both these debts that are currently in place, then that wouldn't be an issue, and we just keep going and rocking and rolling. But as it stands right now, we need to be able to get out of these short-term loans and just stay with the 4.5% loan, and that's going to be able to make this deal just take off like a rocket. So this is the process for investing. Number one, you review the offering, get with the person who brought you here. They have a link to the investor portal. You can find the private placement memorandum documents. That's going to go over all the details. Myself, I'm always going to be available if you need anything. Any questions asked, which I'll do a Q&A right after this couple of slides. You e-sign these documents. Everything can be done electronically. Once those are signed, then you're clear to send your wire into the operational account, and property is projected to close July 12th is what we initially were shooting for. And due to the lender constraints, we ended up closing in October. So bought a little bit of time and allowed for some of the renewals to take place. So that was actually worked out in our favor pretty well. So if you're into the deal, Number one, you're ready to make your commitment to the deal. Again, get with your investment relation person who brought you to the deal. They will direct you where you need to be able to go. You can e-sign these documents. If you are an accredited investor, you can do an accredited investor verification so that you don't count towards the 35 cap of non-accredited investors who are going to participate. And then the funding of the deal, you send in your wire, and then we should be good to go. So, a couple of frequently asked questions. Can you invest using your self-directed IRAs? Yes, you most certainly can. When did the distribution start? We're projecting in April, which is going to be 6 months after our close, since we did in October. And our projected annual rent increases, as standard for every deal that I underwrite and analyze, I take 0% rent growth as my calculation for the first year. And then I apply what used to be the inflation standard of 3%. It's a lot higher these days, but still, I like to underestimate my income and overestimate my expenses on everything that I look at. And then how much are we increasing our expenses? Approximately 2% as also standard for growth in costs. Again, if you have any questions, Mickey, her email is on there. I can actually open up the floor right now. I see the chat box has been going pretty active. So let's see what people um, are doing. Oh, and one thing that I did forget to mention as well. I know this says that there's a $50,000 minimum. Um, no, I think yeah, that was it. $50,000 minimum. Some folks were told 100,000, but our minimum is the 50,000. And if you have questions about that, again, you can get back with your investor relations person, and they can talk to you about working with you and making something happen. So yeah, under promise and over deliver. Exactly. But yeah, if you have questions, you can feel free to unmute, raise your hand, ask. If you want me to go back to previous slides for your reference, I can do all of that.
Hey Russell, can I ask a quick question?
Sure thing, Darren.
Thanks. If year three, if you do refi or the loan ends and you have to get a new one, I assume the interest rates will go up quite a bit. Did you factor in what that will do to the return?
Yes. So when we factored in our refinance, we used an 8% interest rate, um, which is still higher than what we're at today. Um, and that's just assuming things got worse. The whole entire principle about this is that we're trying to get our valuation to a place where we're north of $5 million, and it's not going to take nearly that much for us to get there. Because even if the interest rate is really high, then we won't just refinance. We'll just sell. So if it's not feasible to do a refinance, or because we have to either have too low leverage, like we have to leave too much cash into the deal, we're not going to do that. So we're going to look at all options, and essentially, we do a cash out refinance and pay back like hopefully we target that 60%. Even if it's down to maybe like 35 or 40%, it might still be worthwhile. We'd have to stress test that and look at it, which we're constantly doing as we hit major milestones. So once we turn over about half of the units, we'll redo the pro forma and see what we're looking like financially. Um, but hopefully that answers your question.
No, that's great. That's very helpful.
Yeah, we'll refi if we can. If we can't, then we just sell. And just like my first two deals that I showed you guys in the beginning, we couldn't refi the 42 units, so we sold it, and we hit 34% because of the growth of that market. And then the other one, we refied out of our hard money loan and wrote it out for a couple more years, and we sold it 3 years later, and we averaged about 45% on that one year over year.
Can I just ask one more quick one?
Oh yeah.
Um, it's about CapEx. So it sounds like so promising that you might just have to do turnovers on some of these and not actual for rehabs, which is awesome.
Hmm.
But you did mention other CapEx, like you wanted to do some painting and maybe the roofs.
Yep.
Um, do you have a sense of how much you're budgeting for that?
Yes. So our roofs we got quotes ranging between 40 and $50,000 for both roofs to be done. The gutters also need to be done as a part of that, and that's going to be uh, not nearly as much. It's going to be probably about $4,000 to do both sets of gutters. Um, and then the exterior stuff, we're going to, that's not the priority. The priority is going to be the roof. The lender is requiring us to repave the asphalt in the parking lot because there's, I think, there's a pothole in the front facing side. That one's going to be about $7,500. And then because there's not a big parking space, but that it is actually a source of revenue for us because there's preferred parking for those individuals and they pay us for their own private parking spot. Uh, a couple of questions that I missed here. Am I looking for a private investor or am I open to a capital company? At this point, for this raise, we're probably looking just for private investors. We probably don't need a capital company just because of the size of this. It's not that big of a deal. Um, I'm always open to conversations. We'll see how things go. Um, Not only for this one, but for future deals that we have in the pipeline. Mickey's working on another development deal over in the Midwest, and then um, again, we have the Michelangelo that we are going to be looking at to see if we can strike a deal with the seller before he brings it to the market. So he's already sold to us once. He definitely wants to sell and make it easy because we were pretty solid with him. If Irfan is asking how long is the money locked for, and what are the contingencies uh, on a legal perspective for investors? So the money is locked into the deal for as long as we operate the deal. The only time the money comes out of that deal is like a return of your capital. You'll be getting a return on your capital as we cash flow. We'll pay distributions on your money, meaning that if you invest $100,000 into the deal and you're getting your 6 or 7% upfront, then that's a return on your capital. Like if we pay $7,000 to you, it's not like your loan balance goes, your investment balance goes to 93,000. You still have $100,000 invested in the deal, and you're earning an interest on that. Once we do a refinance and we return $60,000 to you, that's one capital event that can get a return of your capital. And so now you only have $40,000 left in there, still earning your 7% on that. Plus, you have your ownership percentage of the cash flow that's going to get you that double-digit cash on cash return on the back end. Let me know if that wasn't clear, or fine. And anybody else have any other questions that they're looking for?
So, hi, this is Maria. I have a quick question, and
Hey,
and
Marty.
I'm sorry because I totally I missed what you were saying on the loans that you currently have outstanding. I heard you say that there's one at like 4.5% that you want to keep, and then there's another one that would have to refi. Is it only two, or did I miss another one?
No, there's three total loans. So
Okay.
we have the large first lien position loan, that's the $2.3 million dollars.
Mm-hmm.
And then we took out a hard money loan and the line of credit for the cash to close the deal on time.
Okay.
Yep. So those are the two deals that we're looking to replace. So it actually is more expensive because investors are expensive because you guys
Yep.
get preferred returns and then 70% of the ownership. So ideally, we'd want to keep the loans in place, but they have shorter timelines, and those timelines are coming up quick.
Okay.
Yep.
Thank you.
Good question. Thank you. Adrian had asked, when do distributions start for the private investors? We're projected 6 months out, which would be at the end of April. So probably May 1st is when the first distributions will start paying out. Even if you started your investment today, you'd still be in that Class A because there's only two classes of investors on this deal. You have the Class A investors, and then you have the general partnership investors. Um, and so the Class A, which is the common equity for the 70% ownership of the deal, um, if you come in at any point before those distributions start, you're going to be in that class and treated as such. And there are no performance hurdles on this particular deal. A lot of times, if you start looking into syndications, you'll see how they call it a waterfall because there's a lot of different steps down, right? The way the money trickles down. Then after you hit a certain return metric, then the terms of the deal change. You're no longer a 70% owner. If let's say you hit like 15% returns on your money, then they're going to split the returns 50-50 with the general partnership. That happens very, very often in a lot of deals. This deal is a straight 70-30. No matter what happens with this deal and how much money we're projected to make on the performance of this deal, you're always going to be a 70% owner, proportionally to whatever you put in. If you write a check for $1.6 million, then you're 70% owner in the deal, basically. But you probably have to sign on as a sponsor if you're going to do something like that. So, plus there's only, I think, 1.1 left because we have 500,000 already. Um, okay. And I think that's it. So, yeah, again, I did that in less than an hour, so that's pretty cool. Thank you guys for joining me on this presentation for the Donatello. Again, get with the person that brought you here. Have a conversation with them. Go through the private placement memorandum. If you have any questions whatsoever, you can always reach out to myself or to Mickey. Her email is here. My email, if you need, I can put it in the chat. Rasul CRE or CRE that's the easiest one. Yeah. If you have questions about syndications or how it works, I actually have some resources to kind of educate you a little bit more, a little bit further, and I can get you some stuff to get better suited. And again, this one's first come, first serve. So as this deal fills up, if you don't make it in before the last investor comes in, then we'll just keep you posted on whenever we find the next deal. And again, we've been hammering through lots and lots of potentials and putting offers out there at prices that make sense for us. In this case, we bought this property for about 118,000 per unit. And again, these other units are going for anywhere between 200, $300,000 a door in the Central West End. So we feel pretty good about where we're at on our entry. And that's where you make your money in real estate, in any investment, is you make it on the buy so that you have a safe, smooth landing on the back end. And 3 years from now, even the ups and downs in the economy, it doesn't matter what's going to happen. This deal's already proven to be highly, highly lucrative. So, stop my share. All right. Thank you guys for joining. Is there any questions? Anybody else? I don't know. There's quite a few folks that are on here. I want to make sure that I got everybody. All right, cool.